Today, we're diving into the latest XAG USD technical analysis and what's really happening in the silver market right now. If you've been watching silver over the past few weeks, you already know this has been one of the most volatile periods we've seen in a long time. Prices have dropped sharply, sentiment has shifted, and now traders are trying to figure out whether this is the beginning of a deeper crash or the setup for the next big opportunity. Let's start with where the market currently stands. Silver, or XAG USD, has recently been trading in a wide and unstable range, roughly between the mid-60s and mid-70s per ounce. Just a short time ago, prices were pushing much higher, but a strong wave of selling pressure came into the market and triggered a steep decline of more than 20% during March. That kind of move is significant, not just in terms of price, but also in terms of psychology. When a market drops that quickly, it usually shakes out weak hands and resets expectations across the board. Right now, the price action is showing signs of stabilization, but it's important to understand that stabilization does not automatically mean a reversal. What we are seeing could simply be a temporary pause before the next move, and that's why today's key support and resistance levels are so critical. Let's break down the support zones first. The most important area to watch on the downside is the region between $64 and $68. This zone has acted as a strong reaction area recently, where buyers stepped in to slow down the decline. Each time price approaches this range, we are seeing demand increase, which suggests that some traders and institutions consider this level attractive for accumulation. However, there's a big warning here. If silver decisively breaks below the $64 level, it could trigger another wave of selling. Why? Because below that point, there is very little historical support in the recent structure, which means price could move quickly toward lower levels, possibly into the low 60s or even high 50s. This is what traders call a liquidity gap, where price can accelerate due to a lack of strong buying interest. Now let's move to the upside. On the resistance side, the most important zone right now is between $78 and $80. This area has become a major barrier after the recent sell-off. Every attempt to push higher has struggled near this region, and sellers have consistently stepped in to defend it. For the market to shift from bearish to bullish in the short term, we would need to see a strong breakout above this resistance, ideally with high volume and follow-through. If that breakout happens, it could signal that the correction phase is over and that silver is ready to move higher again, potentially targeting the mid-80s or beyond. But until that happens, the market remains under pressure and traders should treat rallies with caution. Between these two major zones, we currently have a consolidation range forming. Price is moving back and forth without a clear direction, which is typical after a strong trend. This kind of behavior often confuses inexperienced traders, but for professionals, it's actually very useful. It allows them to identify key levels, build positions, and prepare for the next breakout. Now let's talk about indicators, because they provide additional insight into the market's condition. The Relative Strength Index, or RSI, has been hovering near the oversold region. This tells us that the recent selling pressure may have been overextended, and a short-term bounce is possible. However, RSI alone is not enough to confirm a reversal. In strong downtrends, the market can stay oversold for longer than expected. Moving averages are also important here. Currently, price is trading below key moving averages, which confirms that the broader trend is still bearish. As long as silver remains below these dynamic resistance levels, the path of least resistance is still to the downside. Another key factor to consider is market sentiment. Right now, sentiment is mixed. On one hand, the sharp decline has made silver look cheap to some investors, especially those with a long-term perspective. On the other hand, short-term traders are still cautious because the macro environment is not fully supportive. The strength of the US dollar continues to play a major role. When the dollar is strong, it puts pressure on silver and other commodities because they are priced in dollars. At the same time, interest rate expectations are also influencing the market. Higher rates tend to be negative for silver since it does not yield interest, making it less attractive compared to other assets. Geopolitical factors are also adding complexity. While tensions in global markets can sometimes boost silver as a safe haven asset, they can also lead to liquidity-driven selling, where investors move into cash instead of metals. That's exactly what we've seen recently, which explains why silver did not behave as expected during certain periods of uncertainty. So the big question now is, what could happen next? There are two main scenarios to consider. The first scenario is a bearish continuation. If silver fails to hold above the 70 level and starts breaking down toward 64, the probability of a deeper decline increases significantly. In that case, we could see the market testing lower levels, possibly in the 60 to 62 range. This scenario would likely be driven by continued dollar strength, high interest rates, and weak investor confidence. The second scenario is a bullish recovery. For this to happen, silver needs to hold above key support levels and gradually build upward momentum. A break above the 78 to 80 resistance zone would be a strong signal that buyers are regaining control. If that happens, we could see a move toward 85 or even higher in the coming weeks. There's also a third, more neutral scenario, which is consolidation. In this case, silver would continue to trade between support and resistance without a clear breakout. This would create a range-bound market where short-term traders can take advantage of price swings, but longer-term direction remains uncertain. For traders, this is a critical time to stay disciplined. Chasing the market in either direction without confirmation can be risky. Instead, it's better to wait for clear signals, such as a breakout above resistance or a breakdown below support. Risk management is also key. Given the current volatility, position sizing and stop-loss placement should be carefully planned. The market is moving quickly, and sudden spikes in either direction are possible. To sum it all up, silver is currently at a crossroads. The recent crash has created both risk and opportunity. Key support lies around 64 to 68, while major resistance sits near 78 to 80. The market is consolidating, and the next big move will likely come from a breakout of this range. If support breaks, the downside could accelerate. If resistance breaks, a strong recovery could follow. Until then, expect volatility, uncertainty, and plenty of trading opportunities for those who are prepared. Keep watching these levels closely, stay updated with market news, and most importantly, trade with a plan. Silver is known for its sharp moves, and the next one could be just around the corner.